Hi, and welcome to Market Minute. This is where we nail it. Seriously, we love making money, but we hate losing money even more. So, my marketing team put this together, put this baby here, saying, he's the man, right? So, we wanted to go over kind of what we said in previous Market Minutes, how we made some really good calls, and kind of what we're doing going forward now. So, what did we nail, right? So what did we nail? The 10-year treasury we thought had great value around 5%. Hit that level, we bought it for our clients. So we bought the TLT at roughly $82. It went to 88, so that's over a 7% return. In bond language, that's a big move. That's a very big move because you add to that the yield on it as well. You got a double-digit return on that position so far. So what we're doing with that position, we're putting a stop loss on it. If rates start to go back up, then we're out of that position. And think about this. This is what you do in hedge funds. You take that position, you lever it up 2 or 3 times, and all of a sudden your portfolio in a low risk security, I would say, a low risk security, high quality security, you've got maybe a 20% return on your portfolio. That's just awesome. So what we've been saying also is that you want to own the blue chip stocks, small cap, and small bio. Those companies all have great value. They've all been beaten up. The blue chip stocks you can buy right now and hold them through the cycle. Even if the market goes down, we think they're really attractively valued. So we've been waiting on the technicals. The technicals turn negative. We were looking for a big seasonal move in the markets. It turned negative, and all of a sudden last week we got a short covering rally, and we got these huge moves. So the S&P up roughly 6% last week, Russell 2000 nearly 8%, and the small cap biotechnology stocks were roughly 12%. We think there's more to go. So off this recent low last week, had a nice pop. Nice move, but we think there's more upside. So if you look at the S&P 500, let's look at that really quickly. So if you look at the S&P 500, it's down quite a bit from its recent high. If you're in equities the last 2 years and you haven't done a good job risk managing your portfolios, you have negative returns. So it's now broken below the 200-day, back above the 200-day. It needs to hold the 200-day at least to keep our money invested in it. So the Russell 2000, this is off roughly 17% from the recent high. So these stocks have been decimated. It's still below the 200-day. However, it broke the 20-day moving average. It's now approaching the 50-day moving average, and it's above a support level. We think there's more upside to the Russell 2000. The small cap biotechnology stocks, huge move on the upside. So roughly this 12% move. It is off 30% from the high to date. It's off 60% from the high back in 2021. This group has been just crushed. There's so many opportunities in this sector. When it moves, you won't be able to buy it fast enough. The move's going to be dramatic and it's going to be huge. So what do we do now? So we had this little pop in the stocks. The market got way oversold. The sentiment too negative. Well, let it run. We think we're in a good seasonal period. Let's see how far it goes. If the technicals that are now positive turn negative, what we're going to do is get negative again, get defensive. So if that starts to roll over, then we'll get defensive. Last week's rally was all related to the bond market. So as the bonds yields came down, the bond guys had to cover their shorts, and then the stock market rallied because the stock guys had to cover their shorts. So we think it's all set up to have some positive movement in the year end. If we get good inflation numbers, it's going to help it quite a bit. So we think the inflation numbers are coming down nicely. We think they're a little bit sticky, but we think they're on their way down. The employment numbers kind of feel to me a little recessionary. So we think that this quarter, the fourth quarter, might be a negative GDP number. And then as we get into next year, it's going to get worse. But the employment report showed the unemployment rate at 3.9%. So that's up from 3.4%. Generally, you don't see the unemployment rate going up unless you're in a recession. So we might be quickly headed that way. The Fed made it clear as mud could be, right? They clear as mud could be that they're not raising rates anymore. So I guess the last rate increase was in July. We think you add 12 months to that, and we're at some sort of recession sometime in the middle part of next year or earlier. But right now, the weather's nice, the storm's not here, and the market will probably have some nice seasonal movement to it. This is really interesting. This is the amount of money in money market funds. It's exploded. So what actually has happened is that the government borrowed a bunch of debt, gave it to the consumer. The government has the debt now. The consumer's flush with cash. They have $6 trillion now in money market funds. This is where the fuel's going to come for the next major rally. It's a lot of fuel there. $6 trillion of fuel. That's quite a bit. So that's roughly 13% of the value of the stock market. The stock market goes down, obviously that number goes up quite a bit. So this was talked about last week by some really good investors, noted investors, that they're concerned about the interest costs that we're going to be paying as rates have gone up in the bond market. The U.S. Treasury bonds rates have gone up. Currently at 3%, that's what we're paying on the outstanding debt. That's up quite a bit from roughly 1.5. And now it's maybe, if nothing changes, it's going to 5%. So that is an additional $600 billion of additional interest expense if rates stay where they are. So the federal government is spending roughly $1 trillion in interest expense. That's a really large number. And so perhaps it goes to $1.6 trillion of interest expense annually. That starts to become a problem. At the present, we don't think it's a problem. Rates have gone up quite a bit. The bond market is discounting some of this heavy debt burden by the federal government, and the consumer so far is in reasonably good shape. The big picture, where are we going from here and what's in front of us in the longer term? So we see a mild recession. We see it occurring either starting now and not to be really visible until maybe the first quarter, and then into 2024 it getting worse, and the Federal Reserve having to cut rates probably around middle of the year next year. We believe that the stock market goes up prior to the stock market going down next year. So we think there's a window here to make some money. We use technical analysis to do our risk management. However, we are very fundamentally oriented, but we use the technical analysis to do our risk management, and that'll get us out of the way of a market decline as we have managed those really well historically. But what happened last week was a glimpse, I think, of the leadership on the next market cycle. So what we want to own are these high quality blue chip companies that are selling at 8 to 9 to 10 times earnings. Great companies selling at depressed valuations. Small cap companies, they're highly undervalued. There's a big upside. What works best coming out of recession is small cap, and in particular small biotechnology companies. We think they're very undervalued. And when the recession occurs, the bond market's going to do really well. So there's a lot of price appreciation to occur in bonds still. So if the 10-year Treasury in a recession, the 10-year Treasury will likely fall from around 4.6% to maybe 3.5% or maybe 3%. That's a lot of appreciation potential in that 10-year Treasury. Looking at these undervalued situations, protecting the downside, that's what we call loss averse investing. That's my overall investment philosophy. Thank you. And the best way of really understanding what we're doing is following Market Minute on a weekly basis. That way you can see our thought process, you can see when we initiate a position, and you can see when we get out of it. So if you ever had any questions, go to my website, CFA. Sign up for the hard copy of Mark in a Minute, and then email us if you have any questions. We're happy to help. Please hit like, hit subscribe, and we look forward to talking to you again next week.